Whereas if you have the combination of very, very high debt levels and inflation, that's when they face kind of the impossible scenario. Well, so the TGA is already getting pretty low, the Treasury General Account. Yeah. And so basically what the way this all works is they've already started taking extraordinary measures. It's like if you'd lost your income source and you can't, tap in your credit cards, you have to start drawing down your existing cash balances in order to pay your liabilities. And so that's what Yellen's doing right now. They're supposedly going to get an increase, in these next couple of weeks due to tax season. That's possibly overstated due to how poor most capital gains were, over the past year. So we'll see the magnitude of that. The debt ceiling issue might strike more quickly than Yellen has previously estimated. I'm sure there are a lot of people doing really deep research on that. But I think essentially that is a huge catalyst to be aware of, because ironically, it's not necessarily the debt ceiling to focus on. It's what happens right after it. When they resolve that debt ceiling, and the Treasury tries to raise their cash balance back to their normal target level, that's a huge liquidity withdrawal out of the financial system that is already very tight on liquidity. So, autumn of last year basically was kind of a partial turning point in liquidity, because for most of last year, you had the Fed drawing down their balance sheet, and that was obviously pulling a lot of liquidity out of the market. But then starting in the later part of the year, you had the Treasury really begin to offset that to a significant degree. They were pushing liquidity back into the market while the Fed was pulling it out. And so you actually had somewhat neutral liquidity conditions overall, kind of this choppy sideways kind of, stagnant liquidity environment. And if you get to the end of that, where the Fed is still trying to draw down, and now the Treasury is trying to refill its account later this year, that's a double negative whammy for liquidity, and it might cause one or both of them to have to course correct. But the path between there and here and there, I think, is going to be fraught with volatility. I am very cautious on equities for the next, several months. I think that there are attractive areas longer term, but until we have more clarity on this liquidity situation, we see basically a storm on the horizon. It's unclear how they're going to handle it. Now, if the market correctly sniffs out that, say, the Fed's going to blink and they're going to pivot their liquidity, kind of like they already partially did in March, it's possible the market, say, front runs that, and then it never gets the big sell-off that some of the bears expect. On the other hand, and that's part of why this is a challenging market, because it's so human driven. We're basically trying to predict what a handful of individuals like Yellen and Powell are going to do. So there's a couple ways they can handle that. One is that, obviously if they reach very low cash levels, they can shut down the government for a period of time to extend the period that they can operate without, an outright default on some of the more, either essential payments or the debt itself. So they can extend it with that a little bit, but that obviously has an economic impact on its own right. And then essentially when they eventually have the debt ceiling impasse, one or two things has to happen. Either, the Federal Reserve might have to provide more liquidity, which is awkward given their current inflation mandate, or the Treasury, for example, can shorten their average duration of Treasury issuances and try to draw liquidity out of the reverse repo market. But that also, it doesn't make sense from a number of standpoints. That's the most expensive part of the curve right now, and it also deviates from their normal kind of plan of maintaining rather consistent average durations. So I think that's going to be a big challenge for them, and it's just this multi-month period of, we see decelerating profit margins, we see decelerating growth, we see across the spectrum. If you look at all these different parts of the economy, we see labor starting to weaken to varying degrees, even though that's traditionally a lagging or coincident indicator compared to some of the others. Even that one is beginning to show somewhat fairly early signs of weakness now, and I think a lot of recession indicators are kind of pointing towards that same part of the year, as you pointed out, with the liquidity crisis. And I think that cash, T-bills, cash equivalents, relatively low volatile stocks are ways to maybe weather the storm until we have greater clarity on how they're going to handle these kind of extreme environments.